Hey, it's Richard with Matthews Wealth Management. Today we're going to talk about stock splits. So at the end of July, it was announced that Apple was going to be doing a 4-to-1 stock split. So I kind of want to mention what that means, talk a little bit about what we saw as a response to the stock split, which kind of led me to want to do this video. So let me go through just the basics of what capitalization and shares and all this stuff means. So Apple currently has a market cap. So when we talk about large cap, mid cap, small cap, this is what's considered a mega cap. $1.82 trillion is the valuation of Apple. So that's what 1.82 trillion looks like. This is where you are if you're a millionaire, billionaire, and now we're in the trillionaire world. So trillion is a lot more than billion. Then we look at how many shares exist under Apple. So if you wanted to buy a share of Apple and you had 200 shares, somebody else had 3,000 shares, whatever this looks like, the total amount of shares that are outstanding from Apple is 4.495 billion shares, okay? So we take the 1.82 trillion, we divide it by the 4.495 billion, and that's how we come out to $405 per share, right? So when we're looking at the stock market, and we say, what is the share value or what is the price? So there's a bid and ask as far as what people are willing to pay or sell their shares for. It actually closed at the end of the day, July 31st at $425 per share. I've put up here Morningstar's analysts. They evaluate the underlying company and look at revenue streams and costs and leverage and debt and equity and all this fun stuff, and they said the fair value of Apple currently is $285 a share. So that's pretty crazy. That's one of the biggest splits out there right now as far as what valuation should be. But post-COVID, we just have tons of money flocking to the mega caps. You've got Facebook, Amazon, Netflix, Apple, Amazon, Microsoft. They're just through the roof. So if you follow any of our monthly updates, you can see that the large cap growths are just up, 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 even though the underlying economy is down, down, down. So to kind of piggyback off of that real quick, little aside, these are the underlying fundamentals of Apple, and these are coming from an investment detail report that we run here on at Morningstar at Matthews Wealth Management. For Apple's last year, they're down 2% on revenue. Their operating income's down about 10%. Their earnings per share is down, a fifth of a percent. The book value to share is down 9.6%. And the total equity, looking at cash and inventories minus debts and other loans and so forth, payables, down 13%. Yet their stock value's up almost 100%. So go figure. There are no more fundamentals anymore in investing. So I kind of wanted to throw that up there just to see the stark contrast, and we obviously see that with the fair valuation here compared to the stock price. But let's talk stock splits, right? Because that's part of what I believe is driving this, at least in the last day or so. We're up over 10%. I read an interesting article that the gains of Apple as a dollar valuation and market cap at the end of July were the equivalent of the 33rd largest company in the S&P 500. So just the gains of Apple are replacing entire companies in the S&P. So just a crazy conglomeration of these huge companies. Anyway, when we're saying stock splits and we're saying 4-to-1, because that's what Apple announced, really what's happening here is we're not going to touch this number. This stays the same. So when they say 4-to-1, that means if you own a share, one of these shares of Apple, you're going to get 4 of those shares. So your total will be 4, not 5, right? So when we take 4.495 billion, we end up getting 17. So this times 4, we get 17.98 billion shares, okay? So now we're going to do a different calculation than this one. We're going to take the market cap and we're going to divide it by this much bigger denominator of shares here to figure out what is our overarching price per share. So I can shortcut this because of the associative property of mathematics and say 405.08 divided by 5 says that the share value should come down to 101.27 per share. So there are a lot of new investors in the market. I think that's the polite way of saying it. They may be thinking that the value is going to go up by 4, that this value is going to go up by 4, so now's the time to buy before it takes off. And in fact, it's going to be cut by 4. But I mean, there's momentum. There's something to be said about increasing liquidity, making it easier to buy and sell and trade. I'm not so sure that's true anymore, since we do partial shares at Schwab, and Robinhood is another app that will let you do partial share purchases and sell orders. And so splits are not really accomplishing liquidity like they used to. It used to be that you would have to spend a full $400 a share. And in the world of $600 a week of unemployment, that was pretty much eating up your whole weekly unemployment allocation if you weren't already buying partial shares in Robinhood. So anyway, I hope this helps explain stock splits. I hope it shows the issue here that we have of market prices versus underlying fundamentals. There's a bubble, there's a growth bubble right now. It's very obvious. The question is, when's it going to end? And that remains to be seen. So if you have any questions, feel free to reach out. Otherwise, we're going to see you next time.